This is the Daily Market Rundown live from the Tradelo trading floor. It's May the 2nd. Some highlights from today's show. China signals its willingness to talk. Non-farm payrolls data is now in view. And the Russel Index says we have a dead cat bounce. A good day, traders, and welcome to the Daily Market Rundown. It is Friday, it is non-farm payrolls Friday, and ultimately that means that a calm session in the morning, but what is likely to be a very, very volatile afternoon. So that's the key takeaway from the European session. Not much going on. We've seen a little bit of a sort of a, let's call it a risk, a hedging type scenario. We can see gold bid up. Of course, we can also see the dollar a little bit offered. So going into sort of this non-farm payrolls, the market just seems to want to just hedge its bet slightly against a bit of a weaker print. But again, not quite seeing that same sort of action in the equities, but that is, of course, a different beast. We will, of course, have a full rundown on the non-farm payrolls, but for now, let's get across and talk about some of the key overnight news, starting, of course, with the ongoing tariff back and forward between China and the US. Last week, of course, it was all about the US saying we're talking to China, with the Chinese saying no, we're not talking. This week, it's all about China saying yes, maybe we'll talk to the US, but first we want to see them correct some of their past practices and move unilateral tariffs. Now, there's nothing new here. I think that's the key takeaway. Whilst the market perhaps moved on it, the algorithms moved on it, the point is nothing new has come out from it. There is a willingness from China to talk. The US has shown a willingness, or a sort of waved a white flag this week saying they've reached out to the Chinese to talk. But in reality, the Chinese are still standing by their red lines, which is remove those unilateral tariffs, and fine, we will talk. We don't want the threat, coming into these tariff discussions. And of course, the US is going to want to keep that leverage in place because that's ultimately what they're going to use as a bargaining chip. So the key takeaway, I've said this yesterday, the day before that, the day before that, the day before that, it's still a stalemate situation. There's nothing really positive in this scenario. And until we get either the US saying, fine, we will remove those tariffs that we put in, all the tariffs, the escalatory tariffs in place, and we'll reset it back to Liberation Day tariffs. Unless we get something like that, we're not going to get anything meaningful coming out from a de-escalatory standpoint. Okay, so right now it's in limbo. That's the key takeaway. There's nothing really positive until we get some sort of confirmed, sort of steps either from the US or, of course, from the Chinese. Now, with that in mind, I think it's very much today's all about non-farm payrolls. It's going to take the headline news, and the market really, if I'm going to summarize this coming into it, the market really wants to understand ultimately the impact that the uncertainty has had on the labor market. Okay, why? Well, if you zoom out a little bit, we'll talk numbers in a minute, but if you just zoom out for a minute and just think about the tariffs and the situation in the United States, a lot of companies, a lot of CEOs, we know from sentiment reports, are the most uncertain they've been in many, many years. Okay, surveys are pointing towards a very, very uncertain environment, and we're seeing with all these earnings calls over the course of the last couple of weeks, CEOs or companies are just reluctant to give any form of guidance. Okay, now that uncertainty at some point will have an impact on the labor market. Okay, now the general thinking going into today is that we won't see that impact going into this non-farms because, of course, what happened was we had a lot of companies stocking up ahead of the tariff announcement. And ultimately, the general thinking is that things can only get better from here. Okay, so no companies want to be hiring or no companies want to be firing in this current environment until they get just a little bit more certainty about what comes next. Okay, so it's this idea of hoarding labor. Now that's the general thinking amongst the sort of the consensus economists going into today, is that there's a hoarding taking place and we're not going to see that firing just yet. Okay, now that's the key takeaway. And we can see that in terms of the implied vol coming into this, is the market's not overly concerned. It's not sort of massively hedging itself against a bad number. Now, I think this matters because it reminds me a lot of, if you go back to July 2022, I think it was July 2022, we went into a CPI print with a very similar setup where the market was very sort of relaxed about the idea of a higher inflation print, and we actually had a 0.2 beat on the year over year, and the markets rarely went into a tailspin type environment. I think we're going into this with a very similar kind of approach where the general thinking is, nope, we're going to see a lot of ordering, and we're not likely to see a bad number this month, perhaps next month or the month after. Okay, now that in its own is a trade opportunity, okay? And we'll talk a little bit about the implied sort of risk at the moment when we get to a chart later on. But I just want to stress that we're going into this somewhat relaxed, okay? And we can see that on the 5-day realized vol. It's not that high, and the market is just chilled, okay? Now, let's get some numbers down. Let's talk about some numbers, and then we can obviously talk about some of the key things to pay attention to. First of all, the expectations is for a 138 on the headline. That's that number there. We can see 138,000 expected, with a range of 50 to 171. Okay, now generally as a trader, what you know as a trade, we call it an outlier trade. If you're going to trade these numbers, anything that comes below 50 or above 171, okay, the market was not really positioned for that. Okay, so there will be some degree of hedging today, and there'll be some degree of positioning going into this number. And like I said, the market's quite chilled. Okay, so if we were to get a 50,000 print or a 40,000 print, okay, like I said, in a very chilled environment where the market's not expecting the bad print this month and perhaps only later on in the year, that would suddenly send the realized vol up through the page. Okay, and that's why you would get a 2-3-4% down move in the S&P 500, the Russell. Okay. So it's all about what's expected, what's the implied volatility, and ultimately what does the number come out relative to implied vol and what was expected. Okay, that's how you have to think about these. In terms of the unemployment rate, it's expected to come in again at 4.2, so no uptick this month from last month, with a range of 4.1 and 4.3. Okay, so again, 0.1 either way is the general thinking in terms of the min and max from the economists. And again, anything sort of 4.4 and above, and we'll talk about that chart in a minute, there's going to be some opportunity scope. And likewise, should this tick down again, that could also present some opportunity scope. Okay, and then finally, the average hourly earnings, that's something we keep very close attention to. For one, if we were to see that suddenly start to tick down, that's going to raise fears of stagflation. But of course, so long as that number stays up and it stays high, it suggests that, you know, consumers are still earning a decent wage, and as a result of that, they should likely continue to spend. Okay, so a good number there is good for markets. A bad number obviously starts to point to somewhat deterioration, or at least bosses giving their employees a little bit less pay, and at some point that feeds into the demand side of the equation. Okay, but those are the three key things we pay attention to. Okay, we also pay attention there to the revision. So if we get really big revisions on the previous month, that is something that can move the markets. It seldom does. But if you go back and look at 2008, what ultimately happened prior to the recession, it was a fantastic recession leading indicator, was we got really significant revisions to the non-farm payrolls, like more than 50,000, 2 months prior to the time that Lehman Brothers actually went bankrupt. Okay, so the point is we do pay a close attention to the revisions, but very often they don't actually matter. Okay, so we're looking for a significant revision for that to be somewhat of a recessionary indicator. Okay, now let's get to the charts. Because like I said, it's good and well knowing, of course, what the number comes out, but it's all relative to what the trend is and ultimately what that min and max is. So what we can see on the headline print is that we've pretty much been printing, if I draw a straight line from, sort of Q2 last year to this year, you can see we've pretty much been printing somewhere around 170,000 jobs for the last year. Okay, it's very stable. The labor market is extremely stable. We can also see, if I just showcase the drop that we had moving into sort of August last year, that's when the Fed panicked somewhat. They kind of course, went off of the SAM rule. They cut 50 basis points. And I want to stress that should we get a weak print today, should we get a number less than 50K, okay, the front-end bonds are going to rally particularly aggressively. We will get a very aggressive steepening in the US bond curve. And ultimately, the market's just going to bet that the Fed's going to be moving potentially even as soon as next week. So should we get a really, really bad print, something less than 50K, the market's not going to hang around and wait. They're not going to think anything other than the Fed's going to need to force through a rate cut perhaps as soon as next week, but if not next week, definitely in June. Okay, so that's one thing to pay attention to, is the Fed is very sensitive to weak non-farm payroll prints because obviously one of their dual side mandates is the labor market. Okay. But key thing to stress here, we have been printing on average around 170,000 for the last 12 months. So it's a very healthy labor market. There's absolutely nothing about this labor market that suggests any kind of weakness, right? In terms of numbers to pay attention to, I think less than 100,000, that is going to raise some alarm bells for the simple reason that we're getting a slowdown at a time when perhaps economists weren't expecting. In other words, that hoarding idea, that hoarding theme that everyone's leaning into for this, it's not perhaps actually eventualizing, and that should create a little bit of concern. And then anything below 50,000, like I said, all bets are off. Okay, the market is going to get back to work pricing in that recession. Don't forget that whilst the street has not changed its odds of a recession, I think the street still thinks it's around 50-50 whether or not you get a recession this year. The market, the equity market, seems to be sort of just trading itself back up the page as though everything's going to be hunky-dory. Okay, don't forget the equity markets right now are not pricing in a recession. They're pricing in somewhat of a growth scare, or at least a little bit of a growth slowdown. Okay, so anything less than 50,000, that opens that door back up to a recession and somewhat of an imminent recession. Okay, a recession within the next 3 to 6 months. Okay, so those are the key numbers to pay attention to on the downside. On the upside, like I said, anything above that 170, the market's going to love that. Okay, that's sort of right in line, bang in line with a 12-month average. It's also a really good print. It really just confirms this continued signal that the labor market is strong. Okay, yes, tariffs are creating uncertainty, but at the end of the day, uncertainty needs to lead to layoffs. Otherwise, all you have is just a very strong economy with uncertainty. Okay, and that's the key thing here, is a good number above 170. You will likely see the S&P 500 trade back up to that 5,700. And then again, I think it all depends on how we close today. Okay, is a 170 number a trend day to the upside? No, perhaps not, because it is bang in line with, of course, what we've had over the last 12 months. Okay, should we get a number above 200,000, maybe 225? Well, that does open the door up to a somewhat very strong economy. I suspect the long bonds then will sell off. We'll see a very similar trade action to what we had yesterday, where long bonds sold off post the PMI data. And of course, that's going to have a number of problems. We should see the dollar bid up on that, and we should, of course, see gold sell off quite nicely on that. Okay, gold is very much sensitive to the downside, as well as the likes of euro and pound. So a number above 200, don't be surprised to see some really strong dollar moves as the market starts to price out some of those rate cuts. Okay, keep in mind right now, market is pricing 4 cuts from the Fed this year. Fed told us just a couple of weeks ago that they think only 2 cuts. Let's move on then to the unemployment rate, because this is an interesting one as well. And what you need to know about the unemployment rate is that it very seldom moves. Okay, that's what we're looking at the bottom here. The unemployment rate most of the time oscillates between 0.1 down or 0.1 up. And so what that means is, straight away, if we get a 0.2 either way, that's something that is quite significant. It'll stand out on the chart. It'll be the first time we have a 0.2 since effectively Jan 2024. Okay, so there's your first thing to pay attention to. Like I said, we're expected to have another 4.2 print. In terms of what this 4.4 represents, that is the Fed's median average. Okay, the Fed thinks unemployment will average and be, by December this year, will be around 4.4%. So if we get 4.4 today, again, it creates that sort of concern around, oopsie, are we perhaps in that recession? It creates that concern that the Fed will need to bring forward rate cuts. Of course, you will see Donald Trump coming out very quickly saying cut. And again, the market's going to get to work with the idea of cut. Okay, that means sell dollar, long gold, and of course, like I said, a very, very aggressive steepener type move in the bond market. Okay, so keep an eye on that. A 0.2, sort of to the upside, I think that's definitely going to be problematic. But if we come in slightly better than expected, a 0.1, it's very much again bang in line with that green line, which is the 3-month average. Okay, in terms of the SAM rule, not likely to get that today. We'd probably need unemployment rate or an unemployment number around 5% to trigger that SAM rule, so not something we're going to discuss today. And then just in terms of the range of forecasts, this is quite important. If you look at the Fed members that gave us their dot plot projections in March, they had a range of forecasts between 4.1 and 4.6. Now, keep in mind, this was, of course, prior to Trump's sort of Liberation Day discussion. So it's somewhat stale, and I suspect those do get revised higher. But it still stands that, the Fed members, the highest Fed member, the lunatic on the board effectively thought 4.6 unemployment rate this year. So if we were to get up to a 4.4, we're starting to get into those sort of scenarios where, we should see the Fed come out very quickly and respond to a weakening in the labor market. Okay. Now, just for some contextual interest, I think what we like to do as traders is try and understand, what happened in previous cycles. What does a non-farm payrolls print look like when we're moving into recession? And I think the best antidote to look at is 2008. Okay, why? Well, because if you were trading 2007, 2008, I wasn't, so I don't actually understand it. I only understand it through financial history. But ultimately, it took a very, very long time. Things started slowing already in, sort of midway through 2007. And we only, of course, had the Lehman Brothers crisis towards the end of 2008. Okay. But we started already seeing that slowing effect in the unemployment rate. And then, of course, when Lehman Brothers hit, it steepened very aggressively. What I want to point out to you is, at the start of 2008, we had a really smelly print here. We had almost a 0.3 uptick in the unemployment rate. It then went relatively quiet. And then we had this little area here of just cumulative month-over-month unemployments. Okay, now keep in mind, this was still pre-Lehman. Okay, so it's when you get this consistent, absolute positive change month after month after month, where you get this accumulation of unemployment. That is a very, very strong signaling for a recession. Now, the question you should ask yourself is, why the heck did it take so long for the market to come around to that idea of a recession? Well, keep in mind, in 2008, we didn't have this thing called social media. Okay, we didn't have the access to terminals like we have got today. Okay, the average trader investor nowadays compared to then is far more intelligent, and they respond and react far quicker. Okay, so what are we looking at? What does that mean for today? Well, look, we've had 0.1 the last 2 months in a row. If we get a 0.2, suddenly that means the cumulative effect of the last 3 months is 0.4. Okay, should we get a 0.2 again next month, suddenly it's 0.6. We had a 0.6 unemployment rate change over the last 4 meetings, when we look in the past, we've not had such a thing. Okay, so just keep an eye on that. That is ultimately what happened in 2007 and 2008. Now, in terms of markets, how do we trade this? What do we do off of it? Like I said, there's a relative calm here. And if we look at the 5-day realized vol, we're currently around 5.5. And if we compare that, of course, to sort of Liberation Day, so pre-Liberation Day, we were around 15, 16. We spiked all the way to 100. And we now sort of are really, really docile. Now, arguably, you can say that, or you can sort of think of the fact that the reason why the realized vol is squashed and so contained, particularly over the last 5 days, is because of non-farms. In other words, the market is not doing anything heading into this event. So that's not unexpected. A low realized vol over the last 5 days is quite normal given how important today's non-farms is. But ultimately, the one to pay attention to is that 30-day implied vol. Okay, we can see we are sitting around that 20. It's still well above that 16 level. Okay, so we're still quite a way higher. There's still a little bit of nervousness in the markets. This idea of, we're going to keep going higher and higher and higher. Fine. You would need a strong data point today to ultimately keep the trend intact. But should we get that weaker print, okay, I suspect we could be very close to a low bound in terms of the implied vol. Okay, so right now implied vol is not showing panic. Okay, we know we're near that, that 40 level we had at the peak of, Trump's tariff taper tantrums. But ultimately, we are at the lower bound. We have come down quite significantly off of the recent headline news. So don't be surprised on a slightly weaker number to start to see this implied vol just tick back up. Okay, there is some hedging. Okay, that's the key takeaway here. Investors are hedged. They're not necessarily hedged just for today's non-farms. I suspect they are hedged for whatever comes next. Of course, because the news flow is quite positive right now, that's why we are seeing that implied vol come down. It's almost like there's not a strong reason to be hedging just yet. As we get closer to that 90-day expiry, which comes in 2 months time, then fine, the implied vol is likely to start ticking up into that, because then the uncertainty starts to increase. Okay, but what does this all mean? Well, look, if we get a bad number today, if we get a negative number, if we get a number below 50,000, well, guess what? That implied vol is probably going to need to head back up towards 35. That 5 days realized vol is going to shoot up the page. Okay, and that's what I want to show you, is that the market's going into this a little bit relaxed. Okay, there isn't really a concern, and for good reason. Okay, like I said, consensus is that labor is being hoarded. That's the consensus. We don't get that number. Okay, there's some dramatic type moves we're going to see in some of the equity markets. Now, with that in mind, the Russell's an interesting one. We spoke about S&P yesterday. I think the Russell's are one to pay attention to. It is, of course, the one that's leading to the downside. It is very sensitive to the US economy. And two things I want to point out here. One, in the purple here, what we've got is the city index, economic index, surprise index. Okay, effectively, it just takes all the key data, the hard data, and creates an index from it. And what we can see is it actually topped over the course of the last week and a bit. Whereas the equities kind of continue that move higher. Now, if you cast your minds back, you can see the City Index topped out in November 24, and the Russell topped out a week after that. It's been trending low ever since, and of course, we did have those taper tantrums earlier this year. We've then rebounded off them. Okay. Now, what I want to point out, particularly from a technical perspective, is that so long as the Russell sits below 2,000, this was a significant level. Okay. If you zoom out of this chart and you go all the way back, you can see it's acted as resistance and support so many times. The level 2000 in Russell is going to be a very, very tall order to surge above. Okay, until we get some clarity from Trump, until we get some clarity on what next, until we get some clarity on perhaps the Fed cutting, until there's a lot less uncertainty. Okay, perhaps the implied vol moving down to 16, 17, we ain't going to be scaling above that 2000 for any meaningful period of time. Okay, the Russell is a very good indication of what is going on in the US economy and the uncertainty. Okay, it's like highly correlated to the uncertainty in the US economy, so lean into it. Okay, fine, Nasdaq's rallying. Why? Because the entire retail market is buying the Mag 7 again. Okay, when you have a 10% up day in the likes of Microsoft in one day, it tells you the nature of the markets. Everyone is lumping back into Mag 7, and that's not necessarily the right play. Okay, there's too much uncertainty right now to be long of risk. Until the risk clears, you don't want to be very aggressively buying up the markets. Okay, and like I said, so long as Russell sits below that 2,000, the odds are we're not only going to go and fill that gap at some point, but I suspect we are going to test those lows made back in April, and of course go into that 1650 area. Okay, with that in mind, then it's been quite a long session. We have of course got the non-farms in just under an hour. It's going to be a volatile session. Okay, if the number does come in weak, watch out for the volatility. If the number comes in strong, yes, I think the markets will like that initially, but one key caveat. Yesterday, we had a very good manufacturing data point. Okay, the manufacturing was good. The market thought it would be weak. What did the bonds do? Bonds sold off aggressively. What did equities do? They initially bid up. Why? On the good data. And then all of a sudden, they rolled over. Why? Because don't forget, good data now means less need for rate cuts. Less need for rate cuts is one further problem, of course, for the equity markets. Okay, if there are any other questions, do post them in the Discord. For those of you in the Discord channel, don't forget we've got the competition. It's the monthly competition. It's the guess, the non-farm payrolls. For those of you that are not members of Tradelo, you can also guess. Go into the comment section of this YouTube channel and guess, what do you think the headline number will be for the non-farm payrolls today? Otherwise, good luck out there. Manage that risk. Go make some money.